Hi, my name is Stuart Weems and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And tomorrow I've got an episode where I talk about Charlie Munger's 10 bits of advice that Charlie Munger has and help you sort of apply it to the Australian market and investment principles. And also tomorrow I'm proud to say that I will let you know how to pre-order my new book, Wealth by Design. It's available for pre-order and I have a pre-order offer as well. So I'll let you know how to do that. I've built an AI tool that I'm really amazed with. Well, I'm partly amazed that I'm able to build it, yes, but also I'm really amazed about what it can do. And so it's trained only on the book's contents. And so you can query that tool to better understand the principles in the book, how the principles will apply to your situation, and even you can generate prompts which you can then put into other AI tools such as Claude or ChatGPT or Gemini, whatever whatever your preferred tool is, to then do some research, research on ETFs or properties or whatever it might be. So pretty powerful, amazing tool. It's fun to see, how AI has an impact in different spheres. And, when you go and buy a book, there's a lot of information in there. But the biggest challenge that most people have when they read books is, great, I understand the concept, hopefully, if I've explained the concept simply enough or well enough. But what does that mean for me? And so to bridge that gap, AI can certainly help. Look, it's not a replacement for personalized advice, of course, but I think what it will do is help readers of the book get a lot more value from it. So I did a bit of research. I haven't found any other author that has done it. I guess it's all very new. So anyway, let's see how it all works out. But I've played around with the tool already and, it sort of blows my mind about, how much value then someone can get out of the book. Anyway, that's tomorrow. I promise not to prattle on about it. Let's get in today's Q&A episode. So the first question is from Daniel. Daniel writes, I've just started listening to the podcast and been really enjoying it. I come from a different situation than most of your listeners, but I was wondering if you would suggest for me what to do to try and build some additional income to improve my lifestyle and start preparing for retirement. I'm 24. Good on you, Daniel. You're already thinking about preparing for retirement. I'm 24, currently earn around $80,000 a year. I have approximately $25,000 in shares in several ETFs and some direct stocks, as well as $50,000 in savings. I recently tried to purchase a property. Unfortunately, due to my low income, I'm greatly restricted by my borrowing capacity around $380,000. If I try to buy an investment property, it increases my borrowing capacity, but then I've got to find a deposit, pay for mortgage insurance, stamp duty becomes an issue. What do you suggest I do to start my journey? Should I move my savings into shares or continue to save or try to work towards an investment property? So Daniel, great question. And I reckon there's a lot of people in Daniel's situation, and certainly the proposed tax changes, particularly CGT, the minimum 30% tax on CGT does not suit people in Daniel's situation. For instance, I've got two sons, they're both 19, they're at university, they're share investors, believe it or not, they followed their father's advice. And, now they're going to pay 30% in capital gains tax. I mean, how hard do you want to make it for young people that really don't have a lot of income? They've got part-time jobs, like they don't have a lot of income to get ahead. So, you almost dissuade them from investing, and which is not an ideal situation. Whereas me, their father, more established, I can afford to pay, and I probably will, in most circumstances, pay at least 30% tax rate on any capital gains that I make. So it doesn't move the dial for me, but it moves the dial substantially for them, which is not ideal. Anyway, I'll get off my soapbox. What would I do in Daniel's situation? The first question would be, how can you increase your income, and can you increase your income, and will it increase in the near term? So, there's that great saying, if you want more value, become more valuable. And I guess that's why we, educate ourselves at school and university. And then even once we've done that, we hopefully continue to educate and learn and become more valuable. And so therefore we can generate more value ourselves. So Daniel, I don't know what your occupation is and whether you've got capacity to increase your income, whether in that occupation or a different occupation. But that would be the first thing that I would think about. I mean, your ability to earn an income obviously drives your ability to save. I saw this video online recently and the guy was saying, well, if you just save 30% of your income and you start doing that as soon as you start working, you'll be amazed at the results, which 100%, like we underestimate the impact of compounding capital growth, regular savings pattern, all those sorts of things. But if your income is very low, it's a lot more difficult to save 30% because obviously, your non-discretionary expenses make up a greater proportion of your overall income. So, Daniel, you want to really think, I think there's probably two of the most important decisions you make in life, I think, and you tend to make them when you're young, in your 20s and 30s. The most important is who you marry. The second most important is your career, both from a financial perspective, but also, and most importantly, from a non-financial perspective as well. I mean, if you make a really great decision, it's not work, it's a hobby that you're getting paid for. So that's the first thing I would think about. And if you do have capacity to increase your income, that's where I would put almost all my focus. I think the split between the amount you've got invested in shares and the amount that's in cash is good. I wouldn't probably change that. I mean, if there was a market crash and correction, you might take some more of those savings and put it into shares. But I think you've got the right proportion in terms of growth and defensive assets given you're saving for a deposit. So then I would put all my energy into my career and growing my income and set yourself a bit of a deadline. You say, well, I think I can grow it substantially over the next 3 years. And then in 3 years' time, you got yourself a bit of a deadline. If you haven't been able to do it, then you've got to make an investment decision. But if you've been able to do it, then great. I mean, the risk is that you keep procrastinating and kicking the can down the road. Of course, I don't suggest that. So that's the first thing. So if the answer was yes, I can increase my income, that's what I would do. If the answer is no, I like my job, but the pay rates in that career line, aren't really going to increase very much, then the next thing I would think about is co-investing. So pulling your assets, being your capacity, being your deposit capacity and your borrowing capacity with another person. Be careful here. Obviously you need to have a good relationship with that person and you've got to trust them in order for it to work. And also you want to think about and talk about everything that can possibly go wrong and what you would do if those events did arise before you get into it. So you put everything on the table and make sure, it's going to work. The thing is that co-investing can work quite well, but it is not a long-term solution. So you just have to make friends with that. You might co-invest with a sibling or a very close friend, and probably in the next 5 to 10 years, it's likely that you're going to go in different directions, either financially or lifestyle-wise, and you're going to have to sell the property. Either you buy their share or they buy your share, or you sell it to an independent third party. But that's okay. It's, just make friends with the fact that it's probably not forever, but it's okay. It's going to get you into the market. That's what you really need, is a foothold into the market. So I would explore that. And whether you co-invest as owner occupiers or investors really depends on your situation and locality of property, budget, all these sorts of things. That I'm not too concerned about in terms of whether you make it an investment or a home, but pooling your capacity with another individual is not a bad idea. And then lastly, the third and final strategy I would think about would be buying a property in an area that you can substantially improve. So this is a bit of a short-term focus, but I guess what I'm trying to do here is just increase your deposit amount that you've got, your capacity, at least do something to build wealth. So that might be going and buying, perhaps a villa unit or something in, I don't know what state you're in, but in Ballarat, or, maybe you could find something in Geelong, in a decent regional town that the dwelling is really terrible, so you can make some improvements to it, but the bones are good, so structurally okay, in a good location. And then make those improvements and then sell the property in a few years' time. You want to try and get some growth, so you want to buy well at the right point in the cycle and then make some improvements to it, but it's not a long-term hold. The idea is that you keep increasing your deposit and then hopefully putting yourself in a situation where you can buy something that's a lot more longer term. Because it's a bit of a short-term approach, it's it's third. The other two strategies I spoke about are superior in my view. So anyway, Daniel, all the best. Good on you for listening to the podcast. Good on you for educating. And, you've look like you've saved a pretty substantial amount given your income. So you're obviously good at managing cash flow. And that's, the desire to educate yourself and take action and the ability to manage cash flow well. With those two things, you'll be fine. You'll build plenty of wealth over your lifetime with those two attributes. It's really just about working out which strategy or which steps to take now. Anyway, all the best and thanks for listening to the podcast. Okay, the next question is from Raj. Raj is a first generation immigrant from India. He's 49, his wife's 50. He earns 150,000 plus super. Wife earns about $30,000 working part-time. Raj has two investment properties, both in Perth, valued at about 2 million with 900,000 of debt against it. Rental incomes, pretty healthy rental incomes of 1,600 a week. The home is worth 950 with a net mortgage about 100,000, 34,000 in ETFs. Combined super is 470, which is pretty good for first generation immigrants, I think. But they've actually used some of their super. So Raj just recently bought two more investment properties, one inside super. It's located in Armidale in New South Wales, and another one in Perth, or just outside of Perth, really, outside of super. So the one inside super was purchased for 650 and the new one in Perth for 760. And he's made the comment both properties have good growth since purchase over the last 6 months. Plan is to retire in 10 years on $100,000 of income. And he said he's not sure if he's got enough assets to achieve his goal. Well, if the properties continue to grow strongly, Raj, you probably do. I mean, you've got 4 investment properties with a reasonable amount of equity. So you've got more than $3 million of exposure to the property market. So if those assets grow at 7-ish%, that'll be $6 million, but your debt's not going to grow at that. Your debt's going to stay the same if you're repaying interest only. So you're going to accumulate, let's say, $2 million after tax, perhaps, just roughly, sort of rough numbers, in uplift in terms of, investment assets. I think you're going to be okay. The big question is going to be if the properties grow at or continue to grow at an acceptable rate. And I think in a rising tide all ships rise. I think the Perth properties will. I note that the lower value properties in Perth have outgrown the higher value properties, which is what has happened, in many parts of Australia. So that's not unusual for the current market conditions, but is a bit unusual from what tends to happen over the long term. So, how much can those lower value properties continue to grow by? Look, I think if a property is in a area where it lacks the strong fundamentals that we need from an investment property, so if they're in an outer lying area, on the edge of Perth, for example, then I think once it gets to close to the median value in Perth, I don't think it can climb much beyond that, because why would I pay more? Why would I pay more for that location when I can just move, 5 minutes further or a kilometre further out from Perth and buy something that's much cheaper? And that's the problem with owning property in an area where land supply is abundant, is you might get growth, and as those locations become more and more attractive just from price point, there's going to be a certain price point where they are no longer attractive relative to other property in that capital city. So same with Armidale, New South Wales. It's a regional town. I don't know if you even call it a city. It's probably not large enough to be called a city. I went there once, maybe 30 years ago, so I haven't been there for a long time. Lovely place, but I wouldn't invest in property there. I'd just be open about that. I get that, regional areas, lower value properties, all these sorts of things over the last 5 years, and I've spoken about this in the podcast, have done incredibly well. The problem is, and I did an episode called the Forever Test last year, which is buy an asset that you're happy to hold forever. Do you think Armidale, a regional town in New South Wales, is going to produce similar capital, albeit lower, similar capital growth than property in a capital city? I don't think so. So I think, Raj, in your situation is ride the wave. You're in there now, so I wouldn't make any changes as in sell the property. At least a lot of your property's in Perth, so you'll benefit hopefully from a rising tide. But I think the key success factor in your situation will be, know when to hold them, know when to fold them. So, at some point, those properties I think will become, in a relative value perspective, too expensive, and they'll probably go through a flat cycle. And you don't want to leave your equity in that situation. In fact, what you want to do is probably divest and get more money into super. So the timing could be okay. If you get another 5 years of growth, might sell a couple of properties, put it in super, invest it well, you could do pretty well. But there's nothing. I mean, you're in those properties now, and the reality is that those sectors of the market are performing the best. So you may as well enjoy it, I think, and pick up those returns and then think about what you want to do longer term. But I wouldn't be holding these properties. I don't think I'd be holding these properties for the next 20 years. I guess that's what I'm saying. Anyway, thanks, Raj, and all the best. Okay, next question is from Ollie, and he's recorded his question, so I'll hand it over to Ollie.
G'day, Stuart and team. Firstly, just want to say I love your podcast, recommend it to many of my friends, and I specifically like your concept of patience and long-term wealth building. So thank you. My specific question relates to whether or not I should keep or sell one of my investment properties, partially fund a second-story reno on my family home. The reasons I'm considering selling the property is I'm not convinced it qualifies as an investment-grade property. Purchased it well before I started listening to your podcast. It's in Box Hill, which is a newly formed suburb of Sydney, where thousands of almost identical houses are being built and still being built on small blocks of land. It was completed and first rented just before COVID, so it's already benefited from the recent market increase, and it was done before the building costs increase. So potentially you could argue it's done its dash for the short to medium term, maybe. Also, I didn't borrow 100% of the costs. Again, I wasn't listening to podcasts at the time. So the money I could free up from selling the invested property would pay for a great chunk of the family home. And then I'm thinking I could look to acquire a better investment grade property and borrow 100% of the costs after the fact. Now, I estimate I would free up about $400,000 after paying capital gains tax and other selling costs. And the renovation cost, I estimate after a few quotes, is looking about $750. So greatly appreciate your take and look forward to hearing your opinion. Thank you. Bye.
So thanks very much for that question, Ollie. And it's a really good one because, the general sort of theme or advice with respect to investing is, buy and never sell. And something I talk about a lot too in terms of, making sure you're benefiting from compounding capital growth. But of course, there's always rules that prove there's always exceptions that prove the rule. Got it around the wrong way there. And so sometimes it does make sense to sell property. And I've done that personally, like in terms of to achieve my goals in terms of family home. I've sold property in order to make that more palatable or more affordable, probably is the best way to go. And ultimately, we're investing to provide those choices and achieve those financial and lifestyle goals. So I don't think, we should beat ourselves up too much by making those decisions. But I think if what you've described, Ollie, is a property that has done quite well given its lack of sort of scarcity attributes. And so, I think I take my money and run. And, if you've got lower gearing on it, you think it's in an inferior location, we know that mean reversion always comes into play. So that is where we have a sector of the market or asset class that experiences above average returns. That's typically followed by a period of below average returns. So that means that, your outlook on future returns, even if you thought the asset was fundamentally sound, has to be lower. So I think I'd be inclined. Look, I don't know the property itself. Of course, this is not advice, but given what you've told me, I would be inclined to sell it, put all that equity into the family home. And also I would justify that by saying we're going to sell an asset that we think is impaired. It's not a great asset. We're going to go buy a family home and we assess the quality of that asset through an investment lens as superior to the existing property. So what we're really doing, although there's some transactional costs, what we're really doing is moving the equity from an inferior asset into a superior asset. In the long run, that's always going to be better. And then you can use what you know today in terms of what's going to drive overall strong returns to buy a better quality asset, subject to, of course, since Ollie recorded that question, subject to, the changes in tax rules and so forth, which we will discuss and debate in this podcast over the coming weeks and months. So no need to, worry about it too much. I guess the thing is, actually, I'll make some comments now on this because it sort of leads into that. So since Ollie recorded the episode, of course, we now know that as proposed, not legislated yet, as proposed, that existing properties that were owned, investment properties that were owned, or potentially all properties that were owned before budget night are grandfathered in terms of negative gearing. So one of the things I think that Ollie could be thinking about is, well, hang on, should I sell this asset now because I can't get another negatively geared property? I have some comments to state. Firstly, we should never hold on to an asset just because we want to lock in some tax benefits. For example, if you had a pre-85, a pre-CGT asset, but it was a shit asset, there was no growth in it, what's the point of hanging on to it, right? It's growth first, returns first, then think about tax. That's the first observation. Second observation is that everyone gets negative gearing until July 27. We have an election in probably May 28, which is 11 months later. If over the next few months and years you think that there will be a change of government, then it's possible that, negative gearing will disappear for less than a year, potentially. I'm just putting that out there. I'm not saying make investment decisions on that assumption. Not at all, but I'm just making the observation. And then finally, arguably, Australia, if everything is implemented as proposed, will have the most punitive taxation settings for investors in established property. Now, the answer rarely exists on the edges, on the outline. The answer typically is somewhere in the middle, so you don't want to be the most aggressive tax settings. You don't want to be the most punitive either. And so I think that speaks to, whether these rules, even if they are enacted into law, whether these rules are going to be around for the long term. And we need to think about this, right? Because you don't want to make a decision now thinking nothing's ever going to change and then miss an opportunity or go down a different track. And then in a couple of years' time, you go, well, that was stupid. I overreacted. So, if you look to Keating when he was Treasurer, he tried to get rid of negative gearing, had to reinstate it pretty quickly. I think from memory, it was about 9 months. I should really look that up. New Zealand banned negative gearing in 21. They started phasing it back in 24 and 25. So that's back now. So we can see that, okay, we're a massive outlier based on the proposed, that there's been other situations and it hasn't really worked. And so I think we as investors need to take a long-term view in that regard. So I would still make the best investment decision today, which is sell an asset that we acknowledge, whilst has done well, doesn't have the attributes to drive future growth. Reinvest that equity into a better asset that also is more tax effective, of course, the family home. And then let's just see what happens with the tax legislation. But there could be a little pocket of opportunity over the next couple of years for those that take the view that negative gearing will eventually come back in Australia. And if we take that view, then we might be able to look for opportunities. Again, I'm not encouraging listeners of this podcast to believe that or to even make substantial financial decisions on that assumption, but I'm just saying that it is possible. And for those that want to keep an open mind, there could be investment opportunities for them. But thanks, Ollie, and thanks for taking the time to record the question. It's good to sort of break up the mix, I guess, and hear from listeners rather than my boring voice. Okay, next question is from Zor. There was a podcast and calculations about how much we need to retire comfortably. I kind of get the figures that I require. I believe the calculation was based on the person living in Australia. What if we have the plan to grow old in Asia where things are more affordable? We're both not high income earners, not much super as we arrived in Australia at age 32. We currently have a net worth of about $1.3 million, which consists of 3 investment properties, excluding our home. Own Occupy is worth $950 with $330 of debt, and investing in Vanguard fortnightly of only $33,000. Our plan is to sell 2 investment properties in 3 years' time and invest in index funds and keep one. If we both are 52 now and be happy to retire at 55 to spend time in Asia, we would need about $110,000 a year, including holding costs for one of the investment properties comfortably. Should we pay off the owner-occupied debt? Will our plan work? Any thoughts? Okay, so I guess I do have a client that is doing this in terms of retiring in Asia. It's kind of interesting. The first thing you want to think about is capital gains tax. I mean, notwithstanding, what's been announced in the federal budget, but as a non-Australian tax resident, you don't get the 50% capital gains tax discount. That's interesting. I wonder, I reckon you're probably not going to get indexation as well if they change the rules. But essentially, it means that you're going to pay half of the capital gain in tax. Doesn't make sense to my mind in many situations, unless it's part of a broader plan, unless you want to be pegged to the Australian property market, which if you're moving overseas, going to retire overseas, you don't, to hold property. So that's the first thing is from a taxation perspective, the tax on Australian property when you're a non-resident is too high, which means even if the returns are good, you only keep half of the return, and therefore the tax drag is just too great. Whereas if you own ETFs in Australia and you're a non-tax Australian tax resident, you're not going to pay any capital gains tax. So it's completely capital gains tax free. You may pay some tax on the income. You don't pay tax on franked dividends, but unfranked dividends and interest, you're going to pay some withholding tax. So you want to think carefully about that. But you would, off the top of my head, and I'm not saying this is advice, of course, it's always only information, but you would sell all the properties and invest it in equities. And that's true for your family home as well. So even you can't use the 6-year absence rule as a non-tax resident. Non-tax residents don't get the main residence exemption. So it's really sell all your properties and put it into shares, or probably try and get as much into super as possible. And hopefully you can use some carried forward concessional contributions to offset the capital gains tax. And you might want to think about doing that before July 27 to avoid the 30% flat rate. I'll be interested to see if the 30% flat rate applies to the calculation of CGT pre 27. I suspect it will. But, the benefit of at the moment is that if we have a client that crystallize a large capital gain and they don't have a lot of money in super, we can use the bring forward concessional contributions and really reduce the amount of tax we pay on that gain. As I understand it, that opportunity, if what's proposed gets legislated, disappears after July 27. So I guess there's some planning opportunities there. And so will you have enough money? Well, you said 110, including holding costs, but if we get rid of all the property, then we get rid of holding costs. I'm going to imagine or assume that the living cost of living in Asia is going to be a lot lower than what it is here in Australia. And if you sell all the property, you might end up with, before tax, maybe a couple of $1 million. Again, I don't know, sort of circa that amount, let's say, and I don't know how much the tax is, but let's say it's something in that vicinity, let's say north of 1.5, then you're probably going to have enough money to run a perpetual portfolio. Sorry, not a perpetual portfolio. You probably will run down the balance, but you're probably going to have enough money to live a pretty comfortable retirement. But, that's not advice, that's just off the top of my head. So I think the key success factor here is now really about where you're going to hold your wealth when you become a non-tax resident. So, whether you hold any property. And then I guess the other factor is, how are you going to invest it then so that you can achieve the highest absolute return? So that is income and capital growth, which is really in equity markets, I would have thought. But how are you going to deploy that money so that it works hard for you, over the coming decades? I think if you can, address those two key success factors well, I think you'll be okay. So, Zor, thanks so much for your question. Okay, final question for today is from Ryan. Ryan's a general practitioner, GP, 38, earning 350 to 400,000. He works in a regional location. GPs tend to earn a little bit more there. Partner is 32, just finishing or close to finishing training. Currently 160, will be about 200, 250, and in 24 months, the same as me. So we've got two partners here, very high income earners. Ryan owns a apartment in Darwin with waterfront sort of views, ocean views, etc. There's an investment property in Broome in WA, Cable Beach, and then an investment property in Jindabyne. It's a single bed unit, etc. I think it looks like it's Airbnb'd, so for a bit more income. A little bit of crypto, not really interested in crypto, but bought it out of FOMO. Direct shares, 60,000, ETF, 130, and just some small investments in some unlisted businesses. About 100,000 in offset account. And so here's Ryan's plan. He plans to use as much equity as possible in Darwin property, go and buy investment property in Brisbane, and spend as much as as he can afford, so about the $1.3 million mark. Doesn't want to sell any ETFs or shares. And they'll be moving to a different location where they'll have free accommodation and their salaries will be higher. And then in a few years' time, they plan to improve and sell the Broome property. And what they'd like to do is buy their dream home in a small coastal acreage that might be worth $1.5 to $2.5 million. Kids are on the card in the coming years, but I'm wanting to have everything in place and slightly more for that period of life. In general, what do I think about this strategy? Okay, so this is right in our wheelhouse from a pro solution perspective because we deal with a lot of medicos, but a lot of high income earners. The thing you've got to think about as a high income earner is you want to put that income to use and you want to use leverage as much as possible and you want to reduce the taxation drag. That's true, I think, for everyone, but the taxation drag can be greater for higher income earners. So you want to really think about the assets that you're investing in. You want to think about absolute return, overall return, so income plus capital growth. And you want to invest in assets where, you get the least amount of income and the most amount of growth, both from a tax efficiency perspective, investment efficiency perspective, but also to help you achieve your goals as well. If you can get compounding capital growth, you're going to have enough borrowing capacity probably to go and buy something for $2.5 million in 3 or 4 or 5 years' time. So the ability to buy that asset is not your challenge. Your challenge is the ability to pay for that asset eventually. And the best way to pay for that is really by benefiting from compounding capital growth. So the investment properties that you've described to me, I don't know if they're really fit for purpose. I think that they're probably producing too much income and maybe not enough capital growth. And so that creates that income tax drag, which is kind of the reverse of the assets that you really need given your situation. Your young, high income earners, it's all going to be personal services or mostly personal services income, if not all, which means it's all going to come into your personal name. So you're in the highest marginal tax rate. And so you want to reduce that tax drag as much as possible. It's really hard to make comments given the backdrop of, the federal government proposed changes to taxation. But I think one of the things so I probably wouldn't make any big plans yet until that becomes a bit clearer. And look, I acknowledge that could take 3 to 6 months for things to become clearer. But anyway, I think it's still the best approach is just to not make any major decisions yet. But if we did have some negative gearing changes, then in your situation, if you're going to work in a location where you get free accommodation, you're not going to have a principal place of residence. Could you then make the Brisbane property your principal place of residence? It would require you to actually occupy that property for a period of time and keep those records. And so then what would that look like from an investment perspective, assuming you get no negative gearing, but you've got no capital gains tax for 6 years on that asset? And I'm just thinking out loud, by the way, this is not advice. And then if you share the view, I'm not saying I've got this view, but if you adopt the view that, that negative gearing will come back into vogue eventually, well, then maybe there's some good opportunities over the next couple of years to buy well for a little bit cheaper than what you would have to pay in a normal market. And, you might forego 1 or 2 years worth of negative gearing benefit. But then if you can get a CGT free asset, that might be pretty good. But if the rules weren't changing, what you're suggesting sounds fine. It's really just about what you're investing in, how your ETF portfolio is invested, how your other assets are invested. And then also this next investment, you really want to skew more to capital growth and income. And that's ironically going to not reduce the tax drag, but ultimately help you achieve your goals longer term. You've got the income to do it. It's then really just about choosing the right assets that underpin that strategy in order to achieve that goal, I should say. So I don't have any really specific advice for you, Ryan. I think you're kind of on the right track, except for those existing assets, as I said. But keep listening to the podcast because it's a bit of a moving feast. And let's see what happens over the coming 3 to 6 months. And no doubt, I'll have more to say on how to navigate those changes. So I might leave it there for today. Tomorrow, I'm going to go through Charlie Munger's, which was Warren Buffett's business partner's 10 rules to investing and help you apply it in the Australian market and apply it to everything that I talk about in this podcast. So a bit of a change of direction than what I normally do, but I thought it was a good thing to look at because I really like what Munger typically says, not only about investing, but politics and life and so forth. And tomorrow I'm also going to share how to pre-order the book and the pre-order bonus, as I said at the beginning of today's episode. So until then, bye for now. And before you go, if you enjoyed this episode, please share it with someone that you think will get value from it. And if you have a moment, leave a rating or review on Apple Podcasts or Spotify, as it really helps more people find the show. If you have a question you'd like me to answer in the next Q&A episode, email it to questions@investopoly.com.au. And if you'd like to learn about my new book, Wealth by Design, which is out in a few months' time, head over to investopoly.com.au/book. The link is also in the show notes. And you can also register for the pre-order offer, which is an AI tool that you can use to get more personalized value out of this podcast. Thanks for listening.